The following paid content is sponsored by Rooted Wealth Advisors.
Are you recently retired or nearing retirement? You could be walking into a perfect storm of events that could have significant financial consequences for your retirement savings. Hi, I'm Jeremy Ross, and welcome to Rooted in Retirement. Skyrocketing inflation, stock market volatility, rising interest rates, and out-of-control government spending. How will these events impact you and your retirement? Coming up on today's show, we'll talk about the perfect storm of events that threatens your retirement savings and some little-known strategies that could help protect and grow your nest egg.
Saving for retirement is a great start, but it's what you do with this money that really matters. What's your plan to reduce your taxes, generate income, minimize your investment risk, and pay for the skyrocketing cost of healthcare? Welcome to Rooted in Retirement with Zach Gray of Rooted Wealth Advisors, who's been featured in Forbes and Kiplinger, and he's a published author. This is where you can count on straightforward and objective advice about how you can make the most out of every dollar you've saved for retirement.
Hi, I'm Jeremy Ross, and welcome to Rooted in Retirement. Today we're talking about a perfect storm of events that could threaten your financial security in retirement. Here to talk about it is Zach Gray, founder of Rooted Wealth Advisors. Zach's been featured in Forbes and Kiplinger, and he's the author of The Retirement Roadmap. Zach, great to see you.
Jeremy, it's great to see you too.
We're here to talk about this perfect storm of events that's brewing right now. So let's dive in with the first one.
Jeremy, the first big threat for everyone right now, it's soaring inflation. This is a huge problem and it impacts everyone. This is the highest inflation that we've seen in almost a half a century. And unfortunately, it doesn't look like it's going away anytime soon. And we can talk about inflation statistics all day long, but you don't need to hear that from me. You feel the impact of inflation every single day. Everything is more expensive. Now, I was grocery shopping with my wife, Jenna. We've got 4 little kids. And I tell you what, by the time that we got done checking out just here about a week and a half ago, my jaw was on the floor. And it was a big bill, a lot more than what I was accustomed to just a few months ago, a few years ago. You're paying more for groceries, you're paying more for gasoline, you're paying more for utilities and household staples, travel, automobiles, housing, you name it. Jeremy, you're paying a lot more for it.
And everything has become so expensive, and it's also impacting everyone in different ways, isn't it?
It is, and it could be a lot worse than what we really know. According to economist and inflation expert Peter Schiff, if we measured inflation the same way that we did back in 1982, the real inflationary rate today would be in the mid-teens, and that would make the highest inflationary rate this country's ever seen. Many economists and inflation experts believe that the feds were too slow to react, and it was maybe a case of a little too late. And because of that result, it could be a lot tougher to get rid of this inflation that we're seeing, and this makes a bad situation, frankly, even worse for retirees.
How does inflation affect those retirees?
Inflation is incredibly dangerous for retirees because you're living on a fixed income. Especially at rates that are this high, you only have so much money to spend each and every single month. And as higher prices keep rising, the less money you're frankly going to have for all the necessities, for all the bills that you have. Soon you could be forced to be thinking about unthinkable decisions like choosing between buying food or paying for medical bills. Imagine this scenario, Jeremy. If you had budgeted, say, $5,000 a month in retirement, and that $5,000 a month was going to last you until your 100th birthday. Well, inflation, the way that we're seeing it right now, in less than 10 years, $5,000 today, you would need more than double that, $10,000 a month, just to maintain your lifestyle. So you've gone from withdrawing $5,000 a month from your retirement savings to $10,000 a month. So this could cause you to run through a lot more of your hard-earned money a lot faster than you had ever planned. We see this happen all the time because people overlook and underestimate the impact of inflation, even at normal levels. At normal levels, Jeremy, you're looking at maybe say 2.5%, 3%. Now those costs, they double over 20 years. Hit numbers that we're seeing right now, well, frankly, once again, that's less than a decade. That spells real trouble because when we start to look 20 or 30 years down the road, That could be a train wreck. And aside from inflation driving up the prices of everything that you buy through the roof, it also creates a nightmare for retirees that are trying to generate income to help pay for their retirement. Let's think about it. Most retirees are in a scenario where maybe they're living on pensions or Social Security and then drawing a little bit of their money out. Are those pensions and Social Security keeping up those cost of living adjustments with inflation? No. What about more safe haven type of investments like CDs or savings accounts or treasuries? They're not keeping up either. They're guaranteed to lose money when you consider the impact of inflation, Jeremy, the way that we're seeing it right now. And here's the biggest mistake that I see from people all the time. Their retirement savings goal is based on prices today. They're not looking 10, 20, 30 years from now. So if you don't account for inflation, you could be forced to have some huge sacrifices to your lifestyle as early as in your 70s. Think about it this way. Jeremy, I don't know if you're much of a car nut or not, but my father is, and he's a bit of a gearhead. And I tell you what, as growing up with him, he was restoring and wrenching on cars all the time. And one of those cars was a 72 Chevelle Super Sport. So Jeremy, I don't know if once again you're much of a car buff, but what I will tell you is that was a fun car because we got to go to car shows really all over the Midwest together, and it was a great experience for my dad and I. A couple years ago, Jeremy came to me and he said, "I'm going to sell that vehicle." And I thought, "Dad, I'd like to be the one that buys it." And so when he made that sale to me, I was cleaning it up, getting it back to running order, and I stumbled across the build sheet. Those cars back then, top of the line, $3,000 to $5,000 would get you all the bells and whistles. Today, you can't even buy a golf cart brand new for that type of money, let alone a vehicle. That's inflation. And now what we're seeing with inflation, every time you buy something, that bite is coming out. The question is, what are you doing about it? What adjustments have you made to your retirement savings or your investments so you can stay ahead of inflation? Most people, they're not doing anything. They're hoping, they're burying their head in the sand, and hope is not a strategy because if inflation sticks around for a long time, it could cause you to run through your entire life savings far too soon. And that's why it's important for you to get in front of this right now. And the good news is there's some simple strategies that can help you get ahead of inflation so you don't lose your purchasing power in retirement.
While I am sure a lot of people don't consider how serious the impact of inflation is in retirement, even when it's low, what could our viewers do to help protect themselves?
Jeremy, inflation is a massive problem for anyone who's recently retired or getting close to retirement. But it's not the only problem. Right now, trying to protect and grow your retirement savings, that's surrounded by risk. Most people don't think of this, but the fastest and safest way you could grow your retirement savings today, it's by reducing the taxes you pay in retirement. Think about it. The less money that you pay to the IRS, the more money that you have to spend on you and your family in retirement. And if you take advantage of simple tax planning strategies now, the savings could be significant. It could be tens of thousands, if not hundreds of thousands of dollars. And that's why I put something together just for our viewers on the show today. We will show you how you could dramatically reduce your taxes in retirement with a free, customized retirement tax savings analysis.
Can you explain exactly how this all works?
Sure. Once we get some basic information from you, our team of fiduciary advisors will determine some tax saving strategies that are best suited for your specific situation. Then we sit down with you and share these strategies with you so you can see exactly how much money you could save.
That sounds great, Zach. What is your plan to reduce your taxes in retirement? This is your opportunity to discover exactly how much money you could save in taxes when you retire with a free, customized retirement tax savings analysis. If you saved at least $250,000 for retirement, schedule your free analysis now by calling 800-760-2419. There's no cost or obligation, but this offer is only available if you call today. That number again, 800-760-2419. Are you concerned about stock market volatility and the impact it is having on your investments? We'll talk about why it is a bigger threat than most people realize when we come back.
You're watching Rooted in Retirement with Zach Gray of Rooted Wealth Advisors. This is where you can count on straightforward and objective advice about how you can make the most out of every dollar you've saved for retirement. And now back to Rooted in Retirement.
Welcome back. I'm Jeremy Ross, and you're watching Rooted in Retirement. Today, we're talking about a perfect storm of events that could threaten your financial security in retirement. Here to talk about it is Zach Gray, founder of Rooted Wealth Advisors. Zach's been featured in Forbes and Kiplinger, and he's the author of the Retirement Roadmap. Zach, thanks again for being here today. We're talking about a perfect storm of events that could impact this next wave of retirees. So what is this second big threat?
Well, the second biggest threat that everyone's concerned about right now, it's stock market volatility, and why it could be really challenging for you to get any kind of return in the stock market for the next several years. If you look at what's going on in the markets today, it's helpful to look back at the last major correction or bear market that we had, and that was the 2008 financial crisis. But the stock market went on a tear after that. It was the longest bull market in history. I mean, the average bull market, Jeremy, it's going to last 5 to 7 years. With the exception of that little short correction we had in the pandemic, we've seen the market move pretty much straight up for about 13 years, which is twice as long as the typical bull market. And frankly, people have short memories and they don't think about 2008. There was this huge rally for so long, and that got people thinking that, the stock market, well, it's going to continue on this bull run. Things are good, but you know what? What does go up, well, Jeremy, as they say, it can come back down. And that's healthy for the market, but we haven't had it for so long. Now, when the pandemic hit in 2020, we did have that little bump in the road when it came to performance of the markets. But maybe more importantly, it triggered a number of issues, including inflation, supply chain issues. The Fed responded by tightening monetary policy in raising interest rates. And this is really for the first time in years. Then the war broke out between Russia and Ukraine. And all of these things, Jeremy, they're really the perfect storm of events, and they're shaking up the economy and the financial markets. Even the biggest Wall Street cheerleaders are now saying, don't expect the same returns that you've been getting for the last handful of years, because it's going to be more challenging, and you're seeing that happening right now.
And I'm sure all of this volatility is making people really nervous.
Yeah, but I think the worst thing you can do with market volatility like this is panic and sell. Because when you make those emotional knee-jerk reactions, when you panic sell like that, you lock in the losses and you miss out on some of those potential gains as well when the market does recover. I mean, Jeremy, how many people do you know that sold during the 2008 crisis at the bottom of the market? Or maybe even in that short correction that I mentioned during the pandemic. The stock market soared after those events. And unfortunately, those people lost a lot of money because they sold at a bottom, and they lost out on all of that opportunity as markets soared to new heights. And that's really important for those watching.
Are some of those people trying to time the market with all this volatility going on?
Someone is always trying to time the market, but it's impossible, Jeremy, to do that. You're better off establishing an investment strategy that doesn't revolve around getting in at the right time and getting out at the right time, because there's no way to tell when a stock is at its bottom, and there's no warning when it's at its all-time high either. As the saying goes, it's time in the market, not timing of the market. And by sticking to your long-term investment strategy, a few market fluctuations, Jeremy, they should be easy to navigate.
Should retirees be worried about all this market volatility?
If you retire during a strong economy in a bull market, that's easy. The wind is at your back and you're on easy street. However, on the flip side of that, according to CNBC, if you retire during a downturn in the stock market or a bear market, the combination of the losses in your investments and the need of taking some money out of your retirement savings, that could leave you with 2/3 less money for the rest of your life. This is called sequence of return risk, and it's a huge risk for everyone that's recently retired or on the doorstep of retirement right now. And Jeremy, this really hits home for me because my grandparents, they retired right around the turn of the century. Now, Jeremy, I don't know if you remember back that far or not. We all remember 2008. However, the tech burst of the early 2000s, that was a huge correction. I mean, from peak to trough, that was about a 50+% decline over those early years of the century. My grandmother, my grandfather, they're retiring, they're pulling money out of their accounts at the worst time. And oh, by the way, the 90s were great for the stock market. $100,000, Jeremy, back then, if you just put it into the market, closed your eyes for a decade, it would have more than sextupled in the 90s. It'd be worth more than $600,000. And because of that, a lot of folks were getting riskier than what they knew. So when things turned, like it did for my grandparents and some of their friends and colleagues that were retiring at the same time, they were pulling money out with that sequence of return risk, which for the first time in decades is a massive issue for retirees. And that is going to affect your monthly income because as you go on a fixed monthly income, what happens when the market goes down? You still have to take withdrawals, and now you're taking them at the worst time where you really don't get a chance for that money to recover and bounce back over time. When we meet with someone for the very first time, they usually have a stack of statements and we spread them all out on the conference room table. And maybe they've made some adjustments, but most likely they haven't made a lot of adjustments over the years. And the longest bull run that I mentioned earlier, well, that's thrown their portfolio totally out of whack. And unfortunately, they're taking more risk than they know. And that is a big, big risk at this stage in the game.
How can you reduce all this risk?
Consistently updating and rebalancing your portfolio is the best defense against stock market swings. You should be looking to update and rebalance that, Jeremy, probably every 6 to 12 months. But if there's significant shifts in the market, like we've recently seen, you should be making sure to take advantage of that. Make sure your portfolio is not too aggressive or too conservative. Maybe you need to make some changes and tweaks to your portfolio.
So all of this market volatility could have a huge impact on your retirement savings. What's the best advice you can give our viewers today?
Well, Jeremy, there are strong headwinds for investors right now, and this could last for some time. So if you're trying to grow your nest egg right now, there's risk around every corner. Now, most people don't typically think of this, but the fastest and safest way you could grow your nest egg right now is by reducing your taxes in retirement. Why? Because the more of your hard-earned money that you get to keep in your pocket and the less you have to pay the IRS, well, the more money that you have to spend in retirement, right? That's why I put something together just for the viewers of the show today. Learn how you could dramatically reduce your taxes in retirement with a free retirement tax savings analysis.
Tell us exactly how this might work.
Sure. After we get some basic information from you, myself, alongside our team of fiduciary advisors, are going to determine the tax saving strategies that are best suited for your specific situation. Then we'll sit down and we'll freely share these strategies with you so you can see exactly how much money you could save in retirement. I'm not talking about some obvious deductions that you might save a few bucks with. These strategies could help you save tens of thousands, if not hundreds of thousands of dollars.
That sounds great, Zach. What is your plan to reduce your taxes in retirement? This is your opportunity to discover exactly how much money you could save in taxes when you retire with a free, customized retirement tax saving analysis. If you saved at least $250,000 for retirement, schedule your free analysis now by calling 800-760-2419. There's no cost or obligation, but this offer is only available if you call today. That number again is 800-760-2419. Coming up next, out of control government spending could mean higher taxes could be just around the corner. And we'll talk about it when we return.
You're watching Rooted in Retirement with Zach Gray of Rooted Wealth Advisors. This is where you can count on straightforward and objective advice about the toughest challenges with retiring today, like reducing your taxes, generating income, minimizing risk, and paying for the skyrocketing cost of healthcare. Now back to Rooted in Retirement.
Welcome back. I'm Jeremy Ross, and thanks for joining us on Rooted in Retirement. Today, we're talking about a perfect storm of events that could threaten your financial security in retirement. Here to talk about it is Zach Gray, founder of Rooted Wealth Advisors. Zach's been featured in Forbes and Kiplinger, and he's the author of The Retirement Roadmap. Zach, thanks again for being here today. What is that third threat?
Well, the third threat, it's higher taxes. And there's no secret that our government has gone on a massive spending spree over the last few years. You have economic stimulus, infrastructure updates, a new social policy bill, and really this has pushed our national debt above $30 trillion. It's important for you to understand that the government doesn't have the money of its own. And as my parents used to say, well, dollars don't grow on trees. So the only way for us to pay down this debt is by raising taxes. Most people don't realize this, but taxes are lower today than they've been in 40 years. So given this unprecedented government spending, well, do you think taxes are going to go up, Jeremy? Or do you think they're going to go down over the next few years? Obviously, taxes are likely to go up. The question is, what are you doing about it? You know, someone that I follow is David Walker. He was the former Comptroller General of the United States. He served under 3 different presidents, both Republican and Democrat. So basically, he was the CPA of our country. And this guy, he really knows what he's talking about. And he said the government is going to have to do one of 2 things. Either cut our spending in half or double taxes. And he knows this because he's done the math.
When you take a look at the potential for tax rates, how high could things go?
Well, if you look at tax rates throughout history, taxes used to be much, much higher than what they are today. In fact, the highest federal rate that we saw was in 1944, and that was 94%. And it stayed above 90 for that highest bracket, well, over the next 20 years. It wasn't until 1964 that taxes dropped to 70% for that highest bracket, and those taxes stayed at that rate for the next 15 years. I often say that during the 70s, well, guess what? The highest tax rate, well, it was in the 70s. And so as we look at the highest 37% tax rate that we have today, it's nothing compared to what it used to be.
How could this impact someone who is retired or coming close, nearing retirement?
Well, if you're retired or you're getting close to retirement, these higher taxes, they couldn't come at a worse time. This could drive up the taxes that you'll have to pay when you take money back out of your IRA or your 401k. You could be paying more in taxes on your Social Security benefits, your investment income, and the list goes on. So the money that you're counting on for retirement could end up being a lot less than what you thought it was going to be. We recently had someone come into our office and they had over $2.3 million. And when I sat down with them, frankly, I could tell that he was only there because of his spouse. His wife had kind of nudged him to come on into the office and visit just a little bit. But by the time that we put together a written income plan, what I was able to share with that gentleman, and of course his wife, is that they were likely to run out of money, even though they had multi-millions put away, because at the rate they were spending, most of that money was tax deferred, or it was awaiting taxes when they pulled that money out. Oh, and to make things worse, if one of the 2 of them passed away before the other, they would go from, married filing joint rates to only just one taxpayer, single taxpayer rates. And they would thus be able to spend through that much quicker if they wanted to maintain the same standard of living. So after taking them through our process, which we call our rooted retirement process, we were able to show them some ideas when it comes to taxes that stretched that money significantly longer, left them in a position where they didn't run out of money. And even if one of them did pass, something tragic did happen, we were able to get that money over to something much more tax efficient. So once again, as we go back to that single taxpayer example, well, they wouldn't be spending through that money solely because of tax concerns. This is huge, Jeremy, as you start to think about, well, how long is my money going to last? And frankly, that's the number one question that we get. Do I have enough? Will I run out? Am I going to be okay? Jeremy, these are the questions that are on a lot of people's minds today.
That is a surprising and important story to consider. Now, this could impact the taxes on your income, but are there any other areas that could spell some real trouble?
You could get hit by higher taxes in a variety of different ways, including, of course, higher income taxes that we've been speaking of, But Jeremy, what about higher capital gains taxes? How about corporate tax rates going up? Higher estate taxes, and the list, it just goes on. And here's the kicker, Jeremy. The government has the power to change tax laws whenever they feel like it. They're not asking us for our vote on this. They can raise taxes anytime that they want, and we don't have any say in the matter whatsoever.
Now, most people believe they don't have any control over their taxes, but that's not necessarily true, is it?
No, it's not. That couldn't be further from the truth. You actually have more control over how much tax you pay in retirement more than any other part of your life. The majority of Americans are missing out on a huge tax savings opportunity. They just do the same thing year in, year out. They simply prepare their taxes, they file them by April 15th. Besides some simple deductions that they might get some help with that are going to save a few bucks, what's done is done. But if you really want to make a big impact and save money on taxes, you have to take advantage of tax planning. With tax planning, you're looking forward. You're not looking in the rear view. And that savings could be significant. It could add up to be tens of thousands, if not hundreds of thousands of dollars in your retirement years.
What is the best advice that you could give our viewers out there when it comes to these higher taxes in retirement?
Jeremy, if you have an IRA or a 401k, you might think of it as being your money, and I get that. But really, it's a joint account between you and the IRS. Because remember, you still have to pay taxes when you take that money out, right? And now you could end up paying a lot more in taxes on these accounts than you might have thought before. The good news is there are ways that you could dramatically reduce your taxes in retirement. And that's why I put something together just for the viewers on the show today. Learn how you could reduce your taxes in retirement with a free, customized retirement tax savings analysis.
Can you give us a few more details, explain exactly how this all works?
Sure. Once we get some basic information from you, myself, alongside my team of fiduciary advisors, we're going to determine some tax saving strategies that are best suited for your specific situation. Then we're going to sit down and freely share those strategies with you and show you exactly how much money you could save in retirement. We're not going to charge you a dime for this. Frankly, most advisors don't even have this in their arsenal, and if they do, they're charging hundreds, if not thousands of dollars for this type of analysis to be run. With us, there is no cost and there are no strings attached.
Thanks, Zach. What is your plan to reduce your taxes in retirement? This is your one opportunity to discover exactly how much money you could save when you retire. With a free, customized retirement tax saving analysis, if you've saved at least $250,000 for retirement, schedule your analysis by calling 800-760-2419. There's no cost or obligation, but this offer is only available if you call today. That number again, 800-760-2419. Well, that's all the time we have for today. Thanks so much for watching Rooted in Retirement with Zach Gray of Rooted Wealth Advisors. We look forward to seeing you next time. And remember, it's not what you make, it's what you keep.
The previous paid content was sponsored by Rooted Wealth Advisors.